As we move into 2025, it's important to reflect on our investment strategies. There are various factors we need to consider, such as new policies under the incoming presidential administration, the potential impact of tariffs, and the continuing trend of elevated but slowly decreasing interest rates. These elements will all affect the way we manage our investments. So in this video, I'll walk you through how I plan to invest in 2025. Before we get to that, however, let's take a moment to look back at 2024, review what my investing strategy was, and determine whether there will be any significant changes in my approach for the year ahead. 2024 has been quite a wild ride. For example, the S&P 500 started the year at 4,742, and from there it followed a steady upward trend for most of the year. As of filming, it surpassed the 6,000 mark, reflecting an impressive 27% gain year to date. Similarly, the Nasdaq started at 14,765 and is now well above 19,000, showing a 30% increase for the year. These figures are extraordinary when you consider that the stock market's long-term average annual return has been 11% over the past. Right now, the market appears overheated with stock valuations at higher than usual levels. Take for instance the S&P 500's price to earnings PE ratio, which is currently near 25 compared to 21 just a year ago. Historically, the average PE ratio has hovered between 15 and 20. Even the projected PE for the next year is expected to remain around 25, signaling that stocks may be overvalued. Looking back, my investment plan for 2024 was relatively simple. I wanted to keep contributing consistently to my portfolio, which I did. I decided that if I were going to buy individual stocks, I'd make sure I had a well-researched thesis and would buy with conviction, avoiding getting distracted by trends or impulse buys. The majority of the year, I intended to sit back and let my investments and the power of compounding work for me. While I initially expected that sustained high interest rates would lead to money flowing out of tech and growth stocks, I was wrong. Those sectors performed exceptionally well even before rate cuts were hinted at. On the flip side, I correctly predicted that an election year could be bullish for stocks, and I also positioned myself to dollar cost average heavily into equities if we saw interest rates start to fall, which is exactly what happened at the Federal Reserve cut rates back in September. I began the year with roughly 20% of my portfolio in cash, but once I heard about the expected interest rate cuts around mid-year, I decided to fully deploy my cash into equities. One of my favorite individual stock picks this year was Robinhood, a company I spent a lot of time researching in the summer. I invested and it has continued to perform well. If you're interested in seeing all the details of my portfolio along with exclusive videos and updates, I'd recommend checking out my web community. As someone in my mid-30s, I'm still fully committed to investing in the market. From a traditional portfolio perspective, my holdings are 90% equities, 5 to 7% crypto, and the remainder is in bonds or cash. Some may say this represents too much in equities, but I'm taking steps to ensure that going into 2025, my portfolio will be properly diversified. This may include holding more cash than I have in the past. To illustrate my caution, consider the fact that the PE ratio for the S&P 500 is higher than the historical average, and even Warren Buffett is holding a record amount of cash in his portfolio, about 28% of Berkshire Hathaway's total assets, the highest it's been since 1990. It's unclear whether this is purely a coincidence or if Buffett is simply hedging against a market that seems overvalued. Looking ahead to 2025, a major factor will be the new president, Donald Trump, who will be inaugurated in late January. While Trump hasn't officially unveiled his economic plan, some broad proposals have emerged, including plans to address inflation, lower taxes, reduce regulations, and possibly impose tariffs. I'll cover tariffs in more detail later, but for now, let's look at the other economic policies he's proposing. Regarding inflation, Trump has said his policies would lower inflation, though he hasn't explained in detail how that would be accomplished. One of his promises is to increase domestic oil and gas production to bring down gas prices, but other than that, there's little concrete information. Additionally, Trump has indicated he wants to cut interest rates, but this presents a challenge since high interest rates are one of the primary tools we use to combat inflation. I'm not sure how he plans to reduce both rates and inflation simultaneously, but if interest rates do get cut, it's another sign that you should consider dollar cost averaging into equities in 2025. Trump's party also advocates for reducing regulations which they believe hinder job creation, freedom and innovation while driving up costs. This America First policy may favor domestic producers and manufacturers, so stocks of U.S.-based companies might do better than international ones. However, as history shows, the president's policies don't always directly influence stock performance in the way some might expect. For example, if you look at a fidelity chart of sector performance during presidential election years since 1976, you'll notice that no single sector consistently outperforms when a particular party is in power. In fact, market performance often remains largely unaffected by which party controls the presidency. Tax policy is another area where Trump's proposals could influence investments, especially with respect to capital gains and Roth conversions. He suggested extending the 2017 Tax Cuts and Jobs Act permanently, which would keep individual income tax cuts and favorable capital gains rates in place. Lower tax rates would make Roth conversions more tax efficient, allowing you to convert more from a traditional IRA to a Roth IRA at a lower tax cost. Now let's shift focus to tariffs. As of now, Trump has pledged a 25% tariff on all goods from Mexico and Canada and a 10% tariff on Chinese goods. Tariffs are essentially taxes that U.S.-based companies must pay when importing goods. Though Trump claims that tariffs will protect American jobs and generate revenue for the government, they could also raise consumer prices and slow economic growth. Industries that rely on imports, such as Apple, could see reduced profits due to the higher costs of tariffs, while U.S. manufacturers could benefit from protection against foreign competition. Regarding asset allocation for 2025, I plan to stick to a similar strategy as this year, focusing on ETFs and trimming individual stocks when necessary to maintain balance in my portfolio. If the market experiences correction, I may shift some funds out of growth and tech stocks and into more stable sectors like consumer staples. I'm also planning to keep more cash on hand this year, as having dry powder could be crucial for capitalizing on opportunities that arise. For those wondering about their own asset allocation or risk tolerance, I've linked helpful resources below, including Vanguard's questionnaire, which can help you assess your individual risk and time horizon. Remember, the key to long-term success is to remain disciplined in your investment approach, particularly if you have a time horizon of 10, 20, or even 30 years. As Morgan Housel points out in The Psychology of Money, it's incredibly difficult to beat the market, but if you can stick with average returns over an extended period, you'll likely find yourself among the top 5% of investors. Lastly, let's touch on crude. It's been experiencing a surge lately, with Bitcoin nearing $1,000, while other major cryptocurrencies like Ethereum and Solana have also been doing well. Trump has expressed support for cryptocurrencies, and there are rumors that he may eliminate capital gains taxes on U.S. issued crypto. While I remain cautious with crypto, I think having a small portion of your portfolio, around 5 to 7%, invested in major coins like Bitcoin and Ethereum can be beneficial. If you don't want to manage the coins yourself, Bitcoin ETFs could provide an easier way to gain exposure. As for cash, I plan to hold a little more heading into 2025. At the beginning of 2024, I had about 20% cash in my portfolio, but I have since deployed it. Now I am considering selling off a portion of my individuals to lock in some gains and keep cash available for unforeseen market events. That's my investing strategy for 2025. Let me know your thoughts in the comments below and I'll do my best to reply. Thanks for watching and I'll see you in the next video. Have a great week ahead.